Ah, what a lovely day to browse the internet. Wait a second, what's this? Analyst predicts the next Magnificent 7, and number 4 will shock you? There's gonna be a next Magnificent 7? Oh man, okay. Sell Apple, sell Google, sell Microsoft, sell Amazon.
Oh there, Johnny. Stop panic selling.
Oh, it's you, the floating letter. Okay, look, the internet told me there's going to be a next Magnificent 7, so I'm selling the boring old Magnificent 7 before it's too late.
Johnny, you're a lot, you know that? I'm going to get gray hair from all the stress you cause me.
You have hair?
Listen, the Magnificent 7 probably aren't going away anytime soon, but you've given me an idea. Let's see if we can find what makes these 7 stocks so great, and see if we can find other stocks like them.
So the next Magnificent 7?
No, just a hypothetical group of 7 stocks that are like the Magnificent 7, but smaller.
So I'd like to preface this by saying that I don't think the Magnificent 7 are going away anytime soon. I don't think these 7 stocks, Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, and Tesla, I don't think they're going to lose their market dominance anytime soon. What I'm doing is trying to find the characteristics that these companies share and that made them so great, and find other smaller companies that have these same characteristics. Now, when I say smaller, these aren't going to be small cap stocks. These are still going to be massive companies, but rather than trillion-dollar companies, they're going to be $100 billion companies. So, as I typically do when starting my research, I asked ChatGPT to help me figure out some of the common characteristics of these Magnificent 7 stocks, and of course it spit out this massive essay, so maybe I should have refined my parameters a little bit, but I did summarize it here in this spreadsheet. So here are the current Magnificent 7 stocks at the top, and here are my Magnificent 7 stocks that I've picked to be quote-unquote the next Magnificent 7 at the bottom. We can see that the current Magnificent 7 has an average market cap of $2.3 trillion, and my Magnificent 7 have an average market cap of $300 billion. So still very, very large companies, just not the behemoths that the Magnificent 7 currently are. So the 6 factors that I've found that sort of make a Magnificent 7 stock are steady growth, market leadership, strong margins, a global reach, a business model that's scalable, and a business that is resilient in good times and bad. With these X's, I've kind of marked the companies that fall under each category, and as you can see, most of the Magnificent 7 and most of my Magnificent 7 have most of these characteristics. So let's just start with the first company that I believe will be part of the quote-unquote next Magnificent 7, and it really already should be in the Magnificent 7 because their market cap is actually bigger than Tesla, and that company is Broadcom. So since the Magnificent 7 are all kind of quote-unquote tech companies, I've decided to pick tech companies for my Magnificent 7 as well to try to keep it as close as possible to the Magnificent 7. So Broadcom is a tech company. They design, develop, and supply a broad range of semiconductor chips and software to basically any kind of application you can think of. So their primary market leadership position is in networking for data centers, but their products are also used in broadband and wireless communication solutions. We can see that their stock has been on a tear, doubling in the past year. And like I said, their market cap is almost $1 trillion, so realistically, you could probably consider Broadcom part of the Magnificent 7 already, so maybe it's the Magnificent 8 now. And it's likely due to their strong financials. They have really strong margins. Ignore this last quarter because this was a bit of a one-off, but we can see that typically their net income makes up about 1/3 of their overall revenue, so that's about 33% profit margin, not just gross margin, but bottom line profit margins. And their revenue growth has been strong and steady. Now, they did just acquire VMware, so when you see that they've grown 47% year over year, we have to keep in mind that most of that growth is actually from acquisition of VMware. It's not organic growth. However, we can see that over the long term, they do have that track record of steady growth and that resiliency. They're able to do this through their business model, which combines physical hardware like chips and software like VMware. Broadcom has a nice split, almost evenly, of revenue between hardware and software, so that gives them that resiliency. The stock also pays a small dividend, which is growing over time. Looking at their investor deck, we can see that they have lots of exciting trends that are going for them, including data center, clean energy, smart technology like smartphones and smart devices, connected TV, and more. They also boast one of the broadest IP, which is intellectual property portfolios, with 21,000 patents. I don't know what all these patents are, but it's understood that Broadcom is a market leader in what they do and probably will retain that market leadership position for some time. And if you've ever wondered why Broadcom's ticker is AVGO, look no further than this graph here. The company was originally called AVGO Technologies, AVGO, before acquiring Broadcom and adopting their name. They're also made up of Symantec and VMware, as well as some other bolt-on acquisitions. The one thing I really love about Broadcom is that they're very, very good at making good acquisitions. They're not just going out and buying any old company, they're buying a company that's going to complement their current portfolio, and these acquisitions have somehow made it through the regulatory process and have not been shot down by regulators, so that shows that they're doing something right, that they can make smart acquisitions that aren't too far-fetched and aren't too unreasonable to cause them to become a true monopoly. So I think Broadcom, with their steady growth, market leadership, strong margins, global reach, scalable business, and resilient business model, make them a good contender to be in my Magnificent Seven. Let's go on to the next stock, which is Oracle. Now, if you're like me, when you think of Oracle, you kind of think of a dinosaur company. Oracle has been around for quite a while, but they're still kicking and they're still doing really, really well. So if you're unfamiliar, Oracle is a company that provides cloud applications and infrastructure, as well as database solutions, primarily to businesses. And they also have software such as database management software that they also sell to these businesses. So when we think about cloud computing, you can think of the big three hyperscalers, which are Amazon Web Services, Microsoft Azure, and Google Cloud. However, there are some up-and-coming cloud players such as Oracle and Salesforce, and Oracle is actually really gaining a lot of market share in that space, which has led to this incredible accelerating revenue growth. So we can see that for fiscal 2025, they're expecting their revenue to grow at a faster rate than it has been previously. So not only is it still growing, it's actually growing faster even though they have more revenue. They're going from 53 billion to 58 billion, just a casual extra 5 billion on top of their revenue. No big deal, right? It's quite impressive. And that's also probably why their stock is up 58% in the past year with these positive forecasts. Oracle is almost a $500 billion company, so they're halfway to that $1 trillion mark. And like Broadcom, they do pay a small dividend that's been growing over time. Financially, we can see some steady growth and some strong profit margins, as well as some resiliency. We don't see any back and forth in the quarterly revenues. We see some solid, consistent quarterly revenue, which is going to help them in good times and bad. And if you thought 10% revenue growth for fiscal 2025 was good, well, they're now expecting 12% revenue growth for fiscal 2026. So this company is just really coming back to life, it seems. That's why I think they belong in the next Magnificent Seven. Now, the third company in the Magnificent Seven is still a tech company, but they don't really offer software. What they offer is hardware. And this company has actually been seeing a lot of pressure in the market lately. This company is ASML, which actually stands for Advanced Semiconductor Materials Lithography. That's quite a long name, so I'm glad they shortened it to ASML. Now, ASML is one of what I like to call the big four semiconductor manufacturing equipment providers. So they sort of operate as a peer to companies like Applied Materials, which I own, Lam Research, and KLA. So these four companies are kind of at the heart of the market for equipment that is used to actually manufacture these tiny, tiny chips. ASML is a Dutch company. They're the largest supplier of photolithography systems for the semiconductor industry. And basically their technology is crucial in semiconductor production. You really cannot make semiconductors without their equipment. And they are the only company right now that's offering EUV lithography equipment, which is used to make the world's most advanced semiconductor chips, things like NVIDIA's chips, Intel's chips, and more. Now, the equipment that they make is massive, so they really don't sell that many machines each year, but their machines retail for an average of about $200 million, so they don't need to sell that many products to have this massive revenue that they have. We can see that in 2023, they sold about $28 billion worth of products with net income of $8 billion, so that's a really healthy profit margin of 28%. Now, if we look at their stock, we can see that they've been taking a hit lately, especially in the past few days, with the stock down 20% in just the past couple days. So what's going on here with ASML? Well, they recently pre-released their earnings. It was apparently an accident, a computer error, but either way, they released their earnings a day early, and the market was not happy. Essentially, ASML gave a revenue guidance for 2025, and the market was a bit disappointed by this forecast. For one, it was a wide range, and for two, the low end of the range didn't really promise much growth. So this is in euros because this is a Dutch company. In 2023, the company saw about 27.5 billion in euros in revenue. For 2024, they're expecting 28 billion, so basically flat. And then for 2025, at the low end, they're only expecting 30 billion euros in revenue. At the high end, they're expecting 35, which would be really strong double-digit 25% revenue growth. But at the low end, it's single-digit revenue growth. So this is just a really big range, and I think it speaks to the fact that ASML is really uncertain about what the next year holds for the company, because obviously they're seeing some great demand for their products due to AI, because their products are integral for developing AI chips. However, there's also some geopolitical issues, right? China was a big customer, and now there's bans on exporting semiconductor equipment to China. Intel was also a big customer, and Intel is running into some financial trouble. So ASML definitely seeing a bit of a pullback in their stock lately. However, maybe these things will be temporary, and maybe this is a good buying opportunity. That's for you to decide. But I do believe that ASML represents a lot of the characteristics of a Magnificent Seven stock. They have this strong revenue growth. They are a market leader. Essentially, they're a monopoly in lithography equipment, EUV lithography specifically. They have those strong 30% profit margins. They do have a global reach, and it is a scalable business. I didn't check resilient because of these concerns coming up with the next year. However, you could make the argument that they are resilient because we can see that they've had strong revenue growth and profitability over the past 5 years at least. So maybe they deserve to get a check mark for resilient. I left it blank just to err on the side of caution. All right, my next company that I think maybe belongs in the next Magnificent Seven is Adobe. Now, Adobe also has had some criticism lately. They've had some interesting business practices, you could say, where they've sort of made it difficult for their customers to cancel, and they've really been trying to pivot into generative AI, which really hasn't paid out too well. So Adobe is a bit of a wild card, I would say. However, they are still a software giant, and even if their efforts into AI don't pan out, it's still a household name, and I think it merits a spot on the next Magnificent Seven. If you're not familiar with Adobe, they are, like I said, a software company. They're one of the largest software companies in the world. They're best known for their creative products, so what they call the Creative Cloud. These are things like Photoshop, which has now become a verb, Illustrator, and Adobe Acrobat, which is used for editing and viewing PDFs, as well as creating PDFs. And like I said, they're kind of pivoting into AI, generative AI, with this offering called Firefly, which is their new Gen AI solution. So financially, Adobe really does display that resilience because as a software company, they're able to have really strong profit margins, again, above 30, really strong revenue growth because as long as people don't cancel, it's very easy to continue growing their revenue. All they have to do is increase their prices or get new customers or offer new solutions, right? That's one of the nice things about software companies is that they usually have some built-in growth. We see that their quarterly revenue is up double digits, almost 11% year over year. So that's nice. This may slow going forward because they are a massive company with $5 billion in quarterly revenue. However, I think that Adobe demonstrates all of the characteristics of a Magnificent Seven stock with steady growth, market leadership in that creative software field, very, very high margins on both a gross and net level, a global reach. Adobe is available to customers around the world, a scalable software business model, and resiliency in their revenues. Not too much more to say on Adobe. It is a household name, and I think it's a tech stock that merits a spot in the next Magnificent Seven. Moving on from the software stock Adobe, we have another sort of hardware stock, which is Qualcomm. Qualcomm is interesting because they're a semiconductor company, but they're a bit different than other semiconductor companies. They are the leader in wireless technology, so their chips are used primarily for smartphones, but they're also used in other devices. They're expanding outside of just smartphones and laptops, which are kind of their core business, into designing chips for AI applications, for IoT, which is Internet of Things, as well as the automotive sector, which you can kind of see it's sort of cut off here. There we go, automotive sector. They also boast some other applications such as AR and VR, but that's yet to show enough traction for me to really take that seriously just yet. Qualcomm is known for their Snapdragon processors that they design. These are used in primarily Android devices, but essentially they are the newest leading chip for mobile devices. So laptops and smartphones primarily. Financially, we can see that Qualcomm is also seeing some double-digit revenue growth this year. However, that does come at the expense of seeing minus double-digit revenue growth last year. So you could say that Qualcomm is sort of recovering this year. However, on my little sheet, I did not give them an X for steady growth because it's a bit all over the place lately, and I think that's going to happen when you primarily cater to the smartphone market. Smartphones, even though pretty much everybody, especially in the US, has a smartphone, not everybody is always going to upgrade their smartphones. So it is still a discretionary purchase, even though pretty much everyone has one, and that's, I think, what has led them to not have this steady growth. However, they are a market leader in chips for the smartphone market, and they do have these high margins. So if we look back, they're not quite as strong as the other companies I talked about, but 20% profit margins in the previous year is still not too shabby. We can see that those are even improving with quarterly net profit margins of 23%. They have a global reach, they're scalable, and they're slightly resilient. Even though they did have that year of negative revenue growth, we can see that they're still going strong. And actually, they have a pretty decent dividend of almost 2% that they've raised now for over 20 years in a row. So 20 consecutive years, they've increased that dividend. So to me, that shows resiliency in itself. Looking at their investor relations deck, we can see that smartphones do make up the bulk of their revenue, but it's cool to see that they are expanding into things like IoT, which they actually made $1.4 billion in revenue in the previous quarter on IoT devices. So that's an interesting thing to watch going forward. Let's move on to the second to last stock on my quote-unquote next Magnificent Seven, and that is Intuit. I went back and forth on including Intuit because, I don't know, they're not quite like the other Magnificent Seven stocks, but they do have some household names. So Intuit owns TurboTax, which is very, very popular in the US for filing your taxes every year. But they also own things like Credit Karma, which is used for checking your credit, which is free, but also advertising and selling new credit cards. That's where they make their money there. They own QuickBooks, which is an accounting software for small to medium-sized businesses. And they also own MailChimp, which is an email communication platform for a wide range of businesses. So I use MailChimp quite frequently in my day job. That's how we communicate with our customers. So Intuit, definitely a household software conglomerate for sure. I'm sure that most people watching this video probably have some experience with one of these Intuit products, TurboTax, Credit Karma, QuickBooks, or MailChimp. I'm not sure about their international presence, but at least in the US, they are quite popular. Financially, they have the resiliency of a software company, so they have this strong and steady growth with these pretty decent profit margins. Now, they're not quite as strong as the other companies with just an 18% profit margin, but when we look at the revenue growth, we can see that it's a bit stronger than some of these other companies as well, with 13% year-over-year revenue growth. If you're wondering what's going on with the quarterly revenues, we can see that they have a massive spike in the second quarter of the year. That's when everyone files their taxes. So this quarter is the months of February, March, and April. So everybody kind of gets their tax forms in around February, and then they start filing, and bam, massive revenue spike. Looking at Intuit's checkboxes on the list, I think they do check all the boxes, so they have pretty high margins. They are a market leader, especially in tax preparation and financial accounting software. They have that strong, steady growth, a global reach as far as I'm aware. If you're from outside the US and there's another leader out there for things like tax preparation software, email communication, accounting, I looked into it and I couldn't find, no pun intended, I looked into other companies that are global and I didn't find anything besides Intuit. So please let me know if I'm wrong here, but I didn't find another global leader besides Intuit. And like I said, they're software companies, so they're scalable and resilient. And now, finally, the final reveal. This one is also, I'm not totally sure how I feel about this one, but I think they still belong on the list. My final stock on the list is Palo Alto Networks, ticker PANW. So that concludes my Magnificent Seven, but let's quickly talk about Palo Alto Networks. So Palo Alto Networks isn't quite as broad as the other companies. They've kind of become a leader in their niche. So their niche is cybersecurity. Now, there's plenty of cybersecurities out there, but I picked Palo Alto Networks because I believe that they are the broadest, most well-rounded cybersecurity out there. They offer things like firewalls, as well as network security, data protection, endpoint protection, and more. They also specialize in something called threat intelligence, which is learning about cyber threats and how to stop them. So again, this company has lots of tailwinds in things like AI and cloud computing. as well as things like IoT, where they can secure data for IoT applications. Financially, this company is also looking quite good. We see, again, strong double-digit revenue growth with pretty decent profit margins. We can see the theme that the profit margins have kind of been shrinking as we're going down the list, but still pretty decent profit margins of 16% and strong gross margins of around 70%. As you can imagine, with the growth of AI and the growth of cloud computing, Palo Alto Networks has been able to capitalize on that with some really strong long-term revenue growth. We can see that they went from about $3.5 billion in 2020 revenue to $8 billion in 2024 revenue. So that's really, really impressive. Good job, Palo Alto Networks. And they've started to become profitable. We can see that they were investing heavily in the business, and then all of a sudden, bam, this most recent year, they just focused on having these really strong profit margins. Obviously, there's this sort of odd quarter that's skewing the results, but we can see that a typical quarter still has profit margins in the teens. We can probably expect this revenue growth to continue for Palo Alto Networks with lots of tailwinds in the future, as cybersecurity, in my mind, is not really an optional expense. You can't really afford to have your business get hacked. So Palo Alto Networks products, as well as other cybersecurity companies, have a built-in value proposition in the fact that, well, the alternative is you use someone else or you get hacked, right? And as we've seen, cybersecurity threats are rampant and are probably not going away anytime soon. So if you can't beat them, join them and use cybersecurity solutions so that you don't get hacked. So those are my picks for the next Magnificent Seven: Broadcom, Oracle, ASML, Adobe, Qualcomm, Intuit, and Palo Alto Networks. Now, this video is not a recommendation to buy these stocks. I just thought it would be interesting to see if I could find 7 stocks that are kind of like the Magnificent Seven, because we know that those stocks have done amazingly well, but a lot of people have kind of thought, well, the Magnificent Seven have done so well, they probably don't have a lot of future growth ahead of them. I'm not sure. Maybe they do, maybe they don't. But if you're in the camp that thinks they don't have much growth ahead of them, it's probably worth checking out these 7 stocks to see what you think of them. Thanks so much for watching the video. If you did like it, please hit that like button and please subscribe if you're new. And whatever stocks you decide to buy or own, I hope that they do well. I hope you guys all have an amazing day.